there are two parts of this narrative if you think about it. One is this is inherently going to keep becoming less about how many iPhone units is Apple selling, but really how we're going to monetize this 1.6 billion iPhones that are out in the wild right now in the install base, right? And on the services side, the way we kind of frame this is, listen, the average iPhone user is spending about $62 a year on iPhone services, right? Compare that metric to what you spend on in Netflix, and Peloton, and Amazon Prime, all these other things. This number could easily keep growing. And as long as it keeps going through install-based growth and from new services being offered, we think services alone can grow mid-teens for the next 4 or 5 years. Wearables, really quickly, I think the narrative there is AirPods, despite the fact that we see them fairly often, it has a less than 10% attach rate to iPhone users. Same is true for Watch, by the way. To the extent that number can get to about 20% attach rate, you should see these businesses grow high teens as you go forward. And that's kind of a big theme of less about iPhones, more about monetization of the install base.
Oh, that's interesting. So where does that leave people who've been trained over the years to react to every incremental headline about supply chain, about production growth, about the marginal improvement in the camera product offering? And what about the concern that we used to have, at least, about margins, and that is that they're not as robust and they're not as transparent about services margins than they have been on product?
Yeah, I mean, listen, as an analyst, I would love for Apple to be more transparent on a whole host of things, but I wish for a lot of things that don't come true, I feel. Where does that leave people that model this by iPhone units? And by the way, I still run a model on iPhone units. It becomes a lot less relevant as you go forward, right? I feel like the model we should all be running is how is the iPhone install base tracking versus how our iPhone units selling. I think that metric has to change in terms of what is important. The other part, by the way, to the point you mentioned, services inherently and wearables have higher than corporate margins, which means not only is the growth skewing to the install-based monetization, but this could drive margins and EPS a lot faster than what people have seen historically out of them.
Good morning, Amit. It's Deirdre. I know you're talking a lot about services, but there's a lot of, or at least some uncertainty there, especially movement on the regulation front in terms of payments and the App Store. Just recently, Arizona House passed a bill that would allow developers to avoid that so-called Apple tax. How do you build that into your case? And do you think this is a risk or something that, will kind of peter on like we've sort of seen regulations over the last few years?
It's a great question. And certainly if I had to poke a bear thesis into our entire narrative, it is, can regulation undermine, everything you said, in addition, think about all the issues they've had with the Google licensing deal as well, right? So I think what can happen from a regulatory basis could absolutely be a big risk or a risk on this narrative as you go forward. Now, on the Apple tax or the services tax, right, we've kind of gone and said, hey, if they took that 30% take rate down to 10%, that would imply the total EPS could get impacted by 7-8%, right? And so that's the kind of headwind we're working with. Our assumption would be that, Apple probably has the least amount of regulatory risk compared to big tech as you go forward. And as you said, these things might just peter along for a longer time than be a material headwind. At least that's our hope right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.